Welcome to the Daily Update, where I'll go over the action in the market for Thursday, September 21st. Happy fall day yesterday. And we'll see how things are looking for Friday, September 22nd. We're pretty negative now. We have switched from being kind of negative to looking slightly negative to full-blown negative. Unfortunately, it makes it a little more gray because in the short term, we've got a big, long list of extreme negative indicators that I'll go through. We're looking more negative in the intermediate term, and that's more full blown now instead of just turning negative. But we're at some critical support. And if the market's going to bounce up off of this, if we're going to maintain that positive posture further in the background, the market's going to have to do something about this, or we might lose that and things could turn even more negative. And I'll back up what I'm saying here with the charts that I go through. Let's talk about what happened. Right at the open, we gapped lower, boom. We went right down to S2 at the open and just sat there for a long time. We just moseyed along sideways at 43.62. Then instead of bouncing back up, we chopped above and below S2 for quite some time. And then some late day weakness came in and took prices even lower to close almost at the August 2022 high. Now, this is a pretty critical support level. So we want to see, is the market going to be able to hold on to that? And we have some other support levels in other indexes that we're keeping an eye on. We were down 1.64%, and this is interesting. Volume jumped to above average. We've been seeing below average volume, except on options expiration day. And there was another day about 2 weeks ago where we were down and volume picked up. That's not a real positive sign to see volume really picking up when we're really moving to the downside. The technicals were negative right now. Unless we can hit some level of support and try to bounce up off of that, it's still more follow through from the Fed's stance, but it really hasn't changed all that much. There's nothing new that has really come in to give us any more insight as to what will happen. It's the same scenario. What's been going away is the market's fantasy or hope that things are going to change. And as I said in yesterday's video, we'll get another new hopeful scenario that may be created out of thin air. It may not even be based on much of anything, but that's what the market's been doing for well over a year, almost a year and a half now. And so it's going to happen at some point. We just don't really know when that new rosy scenario will come in, and they'll be able to point to things and say, look, yeah, the Fed's about done. We had some weaker than expected economic reports. Oh, maybe they're going to be able to at least start to lower rates sooner than what they said at the last press conference. So that's kind of how this thing works as we're moving through things. But it's about inflation and interest rates right now. Some comments. The S&P, we did drop below 4,400, and we hit support just a little bit above the August 2022 high. That's a pretty critical level. We've hit that level before, and we're able to bounce up from there. Can we do it this time? We're below the 100 period simple and exponential moving averages, and I'll show you the chart. Interest rates are still going up. Now, they didn't get up for the 10-year over 4.5% before the close, but in the after hours session, we're hitting that level. I've been watching the overnight session since the market closed, and this is back to about where it was from 2003 to 2007, which was a good period of time for the market, followed by a really bad time for the market known as the GFC, or the Great Financial Crisis. And that's what we've been watching for. Even though it seems like I'm saying the same thing day after day after day in the videos, it's because we're watching the same things that usually give us clues to let us know longer term is something bad starting to develop. We still can't really conclude that right now. We just keep watching the things that we can get some insight from. And the Bank of England, they came out, as well as the Hong Kong Monetary Authority, and then the Swiss, they came out and also left rates unchanged. So that's somewhat positive, just like the Fed did. But when you look at Riksbank in Sweden and Norges Bank in Norway, they still raised rates. And now here's our list for the short-term extreme negative indicators that we have. And this list is just, it's grown exponentially since yesterday, where we have the CMB composite, the VIX based on 9 periods, because we've shot up with the VIX pretty fast. The Stoke RSI, the Williams percent are the CCI 14. They were on there. Now we have the CCI 20 that's been added. The stochastics was added yesterday. Another new one, the rate of change going back 5 periods. The force index, that's new. Standard deviation is new. The percent B, the boom indicator, where we look at the 20-period moving average, the RSI 9, and the Connors RSI. This list just blossomed after Thursday's session. We just have in the intermediate term, the PMO studies. We're seeing some things that are extreme negative. And then this scenario where we thought, at least I thought, that it might be shifting to something different. It's really just the same scenario. It's like, okay, are you going to focus on the positive side or the negative side? The idea that the Fed's going to have to keep rates higher for longer. Okay, Jerome Powell confirmed that in his press conference. If things come out strong where good news is now bad news, we're still in that scenario, and we get some strong economic reports, the market's going to freak out thinking, okay, the Fed's probably going to have to raise rates. And there was some talk about that at the Fed meeting. There was a lot of the people that vote that think, okay, we still might need to raise rates even from where they're at right now, let alone cut them. And then we're keeping an eye on the Chinese economy, and then oil is starting to go up again, and that's producing inflationary concerns. The dollar was up, so again, depending on your perspective on things, a strong dollar could be beneficial to you if you're living overseas, if you're looking to travel, something like that. But internally, inside the US, that's typically negative. And then interest rates, which are often not very positive at all, they were also up. And both of those together produced a lot of headwinds. We still have the yield curves. Some of them are starting to bounce up. They were getting very inverted. They're starting to come back up a little bit, but they still remain inverted. Sentiment is now negative. We're at 47. We dropped down to 40. In our trend, we are trending now, both at least the initial stages of a trend. If you're more aggressive, we're in a trend right now. If you're a little bit more conservative, you want to wait and see some confirmation. And I'll show you the charts and what I mean by that. But we're negative now. The ADX is getting stronger. It's crossed above its moving average, but it's still below 20. That's the confirmation that you might want to wait and look for. That suggests that the trend is actually established. Our bias and our momentum continue to be negative. Bias is typically 1 day, and we had a down day. Momentum is the last 2, 3, 4, 5 days kind of taken together. And this is subjective based on my analysis, where I try to let the rest of the charts in the video speak for themselves. All right, the economic reports that came out. We had weekly jobless claims came in at 201,000, a lot less than the 225,000 they had expected. This is suggesting that the labor market remains strong. And this is the Fed justifying either keeping rates higher for longer or maybe at some point even raising them. Last week, they came in at 221,000. The continuing claims also are declining at 1.662 million. Last week, it was 1.683, and I have charts to show you. The Philadelphia Fed Index, this came in down 13.5. That was the reading. They expected it to be down 2. Last time, it was up 12 or a positive 12. The second quarter current account balance, a negative 212.1 billion, and a little bit less than the 222 billion that they had expected being negative. Last time we had the report, it was a minus 214.5 billion. Existing home sales came in at 4.04 million. That's less than the 4.1 million they had expected. Last time it was at 4.07 million. The leading indicators did come in as expected, being down 0.4%. Last time it was down 0.3%. Here is the Philadelphia Fed Manufacturing Index, where it was seeing some improvement, and now we're starting to see some weakness. And here's the current account balance. These aren't real influential. We just want to keep an eye on this, where it is decreasing slightly, but again, it's a deficit is a deficit. Existing home sales continue to show weakness, and that the real estate sector, the housing sector, parts of the housing ETF that we keep an eye on, it had been doing really well. It's starting to see some weakness now as the rest of the market goes down, and this is really bleeding into the whole sector. And real estate's been under a lot of pressure for pretty much all of 2023. Existing home sales also are negative, but they are showing some improvement. And here's the leading economic indicator, or LEI, that's the blue line, and it's showing some improvement here, and that's a good sign. And then we also have this red line, which is the red line is the leading economic indicator, and that's declining. It's the blue line that's coincident. And these are calculations that are made as to what are things doing right now. And this shows that the economy is still doing well, but looking out into the future, it's seeing some weakness. I hope that made sense there. We're starting to get pretty high. At the close in Thursday's session, we were at 4.48% with the 10-year yield. In the after hours, as I said, we're getting up to that 4.5 area. And anytime we're above the 4.02% area, that's when it starts creating problems for earnings, because companies have to pay more to borrow, and that'll bleed through into justifying their stock prices going higher or lower. Here's the weekly jobless claims where they're really falling off. I mainly follow the blue line here, which is showing a decrease, suggesting that things are still strong in the employment sector. Continuing claims are also falling. Here's the moving average where it continues to decline. The unemployment rate, which we had a few weeks ago, actually a week ago, or was that 2 weeks ago? It's hard to keep track. We're at 3.8% with the unemployment rate. And then putting them together, the red line are the initial claims where they're declining. The blue is the continuing claims. They're also declining. And we did have a tick up with the unemployment rate the last time we received that. Here's the intraday chart where we gapped right down to S2. So there's a gap on the daily chart, and that's never a pretty thing. So we'll have to see if that can get dealt with somehow. But we came down to S2 and just chomped along S2, a little bit below, a little bit above, and then going into the close, we even broke down below S2, and we're coming close to this August 2022 high. We're seeing real weakness both in growth and value right now. They're kind of racing each other down. And on a closing basis, we're also seeing the S&P growth to value ratio, not on a closing basis, intraday basis, where it was negative and underperformed. This is the end of day closing basis where we're seeing some weakness here. We've been chopping sideways a lot since March, but we're still in that longer term uptrend. We're keeping an eye on the VIX too. It's starting to go back up. Is that indicative of what's going to happen with the VIX that's happening right now? Because it is starting to go back up. We can see the line chart, we shot above the moving averages, and we really spiked up with the bar chart. The volatility of the VIX is also climbing back above the moving averages and showing greater volatility. Here's showing that we went up pretty far, pretty fast when we look at the RSI of the VIX, just based on 9 periods, where we did go up pretty quick there. And the VIX to VVIX ratio, it's starting to turn back up. It's a little hard to see, but it is going back up now, which is negative. And we were hanging on to this, the 5-period equity put call ratio. It was coming down. It's starting to tick back up now. It's picking up this real rise in the VIX. And if we see more weakness, this is going to turn back up, and that would be negative for the market. Here's the longer term look of that same chart. And then the longer term, we're still going higher with the 253-period simple moving average of the equity put call ratio. That's also turning more negative. The VIX to move ratio. VIX measures volatility of stocks. The move index measures the volatility of bonds. When this is going up, that means that stocks are becoming a lot more volatile than bonds, and that's typically not a good thing. The Ulcer index, we were below the moving average, and now we're starting to come back up. This is another fear gauge that we look at. Looking at the American Association of Individual Investors, this is a week old now, and they tend to react to what's already happened. And we were having difficulties a week ago, so they're now dropping back and looking more negative. Here's another fear gauge that we follow, where it's showing that fear is increasing. Looking at the advanced decline line, we're coming down based on price. We're starting to drop below the moving average based on volume. So that is turning more negative. And we saw a real increase of the new lows with the new highs, new lows study. So we're starting to go down again with our 5-period, and we're just kind of flat to possibly starting to roll over with the 10-period. The advanced decline ratio, we're well below the 0 or the positive to negative line in the sand, both with the blue line and with the red line. This is another thing about the smart money. It's looking more negative as we're declining below a declining moving average. And the chicken money flow is also another smart money gauge that we look at, is showing continued weakness. The cumulative NYSE advanced decline line, we not only broke below this previous low, we broke below another low even earlier, and suggesting that things are turning quite negative. We're also dropping further below this upward sloping trend line. Also, this upward sloping trend line, which is also the NYSE advanced decline line, but calculated in a different way, this is turning more negative. Looking at our advanced decline line studies, we're seeing weakness across the board with the NYSE common stock, the S&P, the mid caps, and even more weakness with the small caps. We're seeing follow through weakness, which is kind of at that point where it's going from short term to intermediate term when we look at our risk on versus risk off ratio. And then here's the trend. We're coming above the moving average now with the ADX, but we're still below 20. The red line is on top and just screaming up right now. So this, if you're more aggressive, you like this and you may jump on this as a trend. If you're more conservative, you want to wait to see the ADX come back up to 20. And in the short term, we're also trending now, negative trend, with the red line really going up. We're above the moving average, but we're still below 20. Here's the daily chart where we have a gap now from Wednesday to Thursday. We dropped below this pivot point, and on the bottom, we were able to get above average as far as volume, and that on a down day. We don't know. Is this more climactic because we're starting to hit support? You can see we're coming back to this previous low where we came down and set this support before. We're just a little bit below that now. Are we going to be able to bounce up off of that, or are we going to just keep falling lower and come back down and threaten this upward sloping trend line? The Stochk RSI is extreme negative. The Williams percent are. The CCI 14 and 20 all are giving extreme readings. Now, they can stay here for a while, but this also suggests that we've gone down pretty far, pretty fast. Also, another one that I don't show all that much, the rate of change going back 5 periods. We've moved quite a bit because we were going sideways for such a long time, and now to see a big move down shows that maybe we've gone down a little too far, too fast. Looking at our moving average study, haven't shown this in a bit. We're starting to get almost extreme with the 20. We're negative with the 50 and the 200 period exponential moving averages. We're dropping down below the rainbow. We were a little bit below it after Wednesday. We're like falling right now after Thursday's session. And on our stochastics, we're getting extreme negative with the short term, intermediate short term. We're negative with the long short term. And again, that's just a further subdivision of the short term time frame. The force index also, after being negative, really shot down, and now it's extreme negative. And the boom indicator, and I always start with this because the 20 period moving average is what we hit first. We're looking extreme negative now. We're getting far away from the moving average. We're negative with the 50 and the 200, but they're not giving us an extreme reading. If we keep going down, then these may come more into play. They're still kind of positive because they're above their midpoints, or we're turning more negative with the short-term 20 period moving average study. We're a deep purple, smoke on the water with the go, no-go system. We're dropping down even below the lowest low value, which is the red line. We're well below the midpoint, where the blue line, which is the highest high value, that's continuing to flatline sideways. The TTM squeeze is dropping below zero and turning more negative. Balance of power also below the dashed line and declining. The Connors RSI, we don't see this one very much. Even though it's pretty spastic, we don't get really extreme or positive or negative readings all that often. We're showing an extreme negative reading. The bullish percent index, we're dropping below 50 and declining. That is negative. And this is internal strength in the S&P 500, which is right now anyways, showing things breaking down. The McClellan oscillator for the S&P is starting to get extreme negative, and I should have put that on the list, but it wasn't there. We're negative with the summation index based on price and volume. We're declining with the NYSE McClellan oscillator. Where we look at the S&P McClellan oscillator, that's just for the S&P. The NYSE is more of a broader measure of the market as a whole. And the summation index for the NYSE, we're declining based on price and volume. We're really looking more negative with the elder impulse system. We've dropped below the 65 period moving average, and there's this ugly gap in here now. And the mass index, we're wondering, is this finally going to come into play now? It triggered a signal and then just kind of laid there dormant. It's starting to move a little bit. Is that going to be a signal? What kind of change of trend are we going to see? We've already been going down. Does that mean that we're going to go up, or are we just going to continue to go down? The PMO, which is one of our momentum oscillators, it's turning more negative and dropping below the midpoint or declining based on price and volume. The PMO study, almost to that extreme negative reading with the PMOs that are rising. We're declining with the buy signals and turning down with the PMOs that are above zero. Swenlin trading oscillator, below zero and declining, both based on price and volume. Below 50 with the NYSE bullish percent index and declining. That's negative. Now, we got a little bit of hope yesterday when we saw the NASDAQ 100 BPI tick a little bit higher. It got lost in Thursday's session and is now looking more negative. We're dropping down below the Ichimoku cloud. We've been staying in here for a long time now, and this could be more negative because the support level right now anyway is not holding. Our oscillators, negative across the board now, short, intermediate, and long term. We're dropping below the 100 period moving average now. We're leaving the 20s and the 50s in the dust, and we came down even below the simple and exponential moving average for the 100 day. We're getting down into the third standard deviation. This may mean that we've gone down pretty far, pretty fast. And we're dropping well below this little mini rainbow. If we stay below this, these lines will start to roll over even more than they are now and start to come down. The parabolic SAR is still negative. We're dropping below the intermediate term rainbow. We've been camped out inside of it for a lot of this crazy move that we've been in that was not showing a trend. Now we're starting to drop below this. The ease of movement, the 1 day, okay, I don't look at that so much. It's the 14 day, where a few days ago we dropped below zero and we're continuing to decline, so that's negative. The Arun, haven't shown this in a while because we weren't trending. We were maintaining a positive stance with our oscillator, but now with the red line shooting up to the top, that means sellers are in control. The green line are buyers, and that's decreasing. So when you take the difference between the two, the oscillator has now dropped below zero. So that's negative. Here's the 100 period moving average where we drop below this S1 level. And now if we try to go back up, is this going to act as resistance? The vortex is looking more negative with the red line going up and the green line going down. Haven't shown this in a while because we weren't really moving. This is the 200-day moving average study of all the stocks in the S&P, starting to show a little bit more weakness. We could come down to these previous areas, which may provide some kind of support. We're down almost to this other area with the 50-period moving average study. Will this provide some kind of support, or are we going to continue to fall below this? The Bollinger Bands, we're coming down to the lower Bollinger Band and actually closed outside of that. That also suggests that more in the short to intermediate term, we are oversold. The prices don't go above or below this and stay there for very long. The fact that we were giving this extreme negative reading could suggest that some kind of a bounce may be attempted. We're looking more negative with the RSI 14. That's just straight negative, where we're starting to get extreme negative with the 9 period. That's shorter term. Now we're having to bring up our Fibonacci charts again, at least a few of those. We're coming back down to this August 2022 high. Will this provide support, or are we going to fall down below this? It held up as support before we saw a nice little run up. Are we going to see more weakness now, or are we going to get some kind of a bounce from this point? Looking at the longer term fib chart, we're also coming back to this 61.8% retracement level. It has acted as support before. Is that going to hold this time as well? In the financial sector, I just wanted to show you that we're still working off of a golden cross here, but it's also seeing some weakness. And the microcaps, haven't had to pay attention to them too much lately because they were well above 100. Earlier in 2023, they did set a new 52-week low, but we're getting back down to that 100 level. Is this going to hold? Will we be able to bounce up, or are we going to fall down below that? Longer term moving average study. We're dropping below the midpoint with the 150 and 200 moving average study. And I haven't shown this in a while, the trend line study. We've been kind of in no man's land where we tried to come back to this intermediate term trend line. That wasn't happening. We hit resistance there and we've been coming back down. Are we going to come back down and possibly hit this longer term trend line going from the 2022 low to the March 2023 low? That could be pretty significant. And then longer term, with our weekly chart of the MACD, we continue to show weakness. And we're looking with our different variation of charts, we're looking more negative here. The Heiken Ashi is negative, the Kegi is more negative, the Renko has switched to negative, and the 3-line break has also turned negative. We also had a couple of new zeros be generated on the point and figure chart. Zeros are negative, where X's are positive, but there isn't any kind of a signal or pattern that's being found, at least right now. The equal weight index is really going down, as is the S&P 500 and the Dow, where we were hanging out below the 50-day moving average, below the pivot point. We're starting to drop. That's the negative side. But on the positive side, we're still above this S1 level and still above the 200-day moving average. But when you look at the Elder's Impulse system, the diamonds are negative. We're possibly coming down to some previous support. We're also breaking support with the NASDAQ 100, but we could come down a little bit further to this other support level, but we're turning more negative here as well. And the Elder's Impulse system for the Qs, which is the NASDAQ 100, that is still negative. And then when we look at our momentum for the NASDAQ 100, with the PPO, we're rolling over and starting to drop below zero. Here's the NASDAQ 100 Fibonacci retracement lines. We're still a ways away from this, but we're going down, so we better bring this chart up just to look at things. And then the NASDAQ also coming down and possibly coming down to a previous support level. Is that going to mean anything? Will we be able to bounce up off of that, or are we going to continue to fall lower? And then keeping an eye on the fib levels. We were chopping above and below the 61.8% retracement level. Now we're coming down and seeing if we're going to hit the 50% retracement level. And then the FANG index continues to be below its 50-day moving average, even though it's in a longer-term uptrend. Small caps just getting hammered these days, dropping below support. Now we're looking to see, will we come down to this S2 level? And we're looking negative here with the Russell 2000. And one thing that I was looking at this chart going, is this a head and shoulders top here? You have the left shoulder over here, you have the top, or the head, and then you have possibly another shoulder somewhere around here. It's a little deformed, but is that what's unfolding right here as we're dropping further below the 200-day moving average? We're starting to look extreme negative with the RSI, but it could still fall further, and we're looking more negative with the MACD. And the Elder's Impulse system for the small caps is clearly negative with the red bar. The mid caps, they were holding up okay above their 200-day moving average. Nope, that was given up on Thursday. So now we're looking at this S2 level. And the mid caps for the Elder Impulse system are also negative. We're seeing weakness with the Dow as we're starting to fall back below this breakout point. The transports are looking even more weak, and now even the utilities are starting to look a bit more weaker. And we're seeing where the transports are actually outperforming the S&P. It's not that the transports did well, it's that the S&P did pretty bad. Now, this is a chart that I found. It's from Game of Trades, and it was on Twitter. And then I have my own variation of this chart that I'll show after this. This is where I've been looking at the NASDAQ to Dow and the NASDAQ or the S&P and other longer term studies. Well, this is the NASDAQ 100 to the Russell 2000 index, where based on this chart, we're coming back up to the level where we were at in 2000, which was the dot-com boom. And then after that was the dot-com bust. Okay. Now I'm seeing something a little bit different, and I have to calculate this in a different way. The Russell 2000, which used to be the Cadillac of small cap indexes, it got sold and it's used in a different way, and it's not really available on stockcharts.com anymore. So I have to bring up the ETF. And then to kind of make it more fair, I bring up the QQQs instead of the NASDAQ 100, where I'm not seeing this real spike up here. So there is a little bit of discrepancy between the two. Take your pick, but this is not necessarily a positive thing. But it's not necessarily something that should produce panic right now either. Based on this chart, we could still go higher. where on this chart, maybe we've topped out already. Just something to be aware of here. And then we just saw interest rates skyrocket up, getting close to that 4.5% with the 10-year yield. As interest rates are going up, we're just gapping massively lower based on price. The RSI is negative. We have a recent death cross. The MACD is negative. This just isn't looking good. We're breaking below previous support levels. Then looking at Tom Bowley, where we're coming into that part, we're in that part now where we tend to see some weakness in the latter part of September. So what's our outlook for Friday? Still dealing with some earnings reports. The UAW strike, it's still continuing, but I haven't really been paying attention to this, but the writers' strike that's going on in Hollywood, apparently there was some positive news about that, and some entertainment stocks saw a pretty good day. We're still wondering, is there going to be some kind of a government shutdown in the near future? It's mostly a political trick, but at the same time, we have to acknowledge it. And then the student loan repayments are supposed to be starting up at the beginning of October, and that could be a drain economically. And then the technicals are negative, and we're starting to develop a trend. This is where you need to decide what is your definition of a trend, when we cross over the moving average or when we go above 20. That's more up to you based on your personality. We will get the S&P Global Manufacturing and Services PMIs. Those are two separate reports. I just have them on the same line here. And then keeping an eye on all the geopolitical events. It's mainly inflation, interest rates, and having this hangover effect from what the Fed was saying. And then possibly saying, are we going to find some support here and try to get a bit of a bounce going? Here's the updated economic calendar showing what's coming out on Friday. Stock Traders Almanac, we're negative across the board with the Dow, S&P, and NASDAQ. Not neutral to negative. September 22nd tends to be quite negative historically. And we will be on the 15th trading day of the month. Even during pre-election years, we tend to see weakness across the board. Carson also shows weakness across the board on the 22nd. We're also coming into the latter part of September for the NASDAQ, where we typically see some weakness, also seeing that weakness for the S&P. We're only up 33.33% of the time with the S&P 500 during pre-election years going back to 1950. Our scenarios, you could lean a little bit more to the downside if you're more aggressive. You're not going with the up one right now. You don't want to try to catch a falling knife if this thing's going to continue to fall even more, or get in front of a moving freight train. You could still go with the sideways pattern because the ADX, even though they're breaking above their moving averages, they're still below 20, suggesting that we could also favor a trendless environment. The warning signs, we're still below those long-term trend signals. I'll go over those again in the weekly video over the weekend. We're in a seasonally and historically weak month, and then in a weak period within that weak month. The equity put call ratio, it's starting to turn back up. The longer term 253 period equity put call ratio is also turning up. The risk on posture is showing continued weakness. Our S&P 500 oscillators, as well as the NASDAQ 100 oscillator, is turning negative. The cumulative new highs, new lows, this has gone on for quite a while now. They are showing weakness. The 3-month yield, we're still seeing interest rates going up, and we're above where we were back in 2007. The Russell's below its 200-day moving average, and is it forming some kind of a head and shoulders top? The parabolic SAR is negative. The Copic curve, it's bye-bye now. It left last week. The vortex is also more negative, and we're dealing with earnings season. The positive side, we have to really kind of search for things. These are further in the background, and they're further long-term with the seasonality and setups that remain, and I'll go through those in the weekly video. The daily special K chart is still positive, and even though it's rolling over, the weekly chart is still negative. We're still above the downtrend channel upper line, which I'll hit in one of the weekly videos. The S&P is outperforming utilities, but another day of this, and this is going to be added to the warning signs because the utilities are starting to outperform. And in the next one, the staples are starting to outperform the S&P. Overall, they're still declining, but if we see this ratio starting to shift more, this may get added to the negative list. The Russell, the small caps index, and the mid caps are still going off of recent golden crosses. We're just seeing some tremendous shorter term weakness. Small and mid cap growth, chopping sideways, still positive, seeing some weakness there though in the short term. And I just wanted to prove this to you. Yeah, the financial sector did generate a golden cross. Doesn't seem to be helping all that much. It held up a little bit after Wednesday, but then it got sucked down lower with everything else on Thursday. So our conclusion, we're negative. We're short term and intermediate term. We're starting to see a trend developing. Again, you need to decide what your definition of a trend is. In the short term, we're negative. The trend is developing, but we have the really long list of extreme negative indicators. We're turning more negative in the intermediate term, and we have a few of our indicators that are extreme negative. We're still hanging in there for right now with the long term where we remain positive. Thank you. I hope you have a very good day on Friday, and I will talk to you in the next video.